Good morning, everyone. I'm really excited to be here. We've been working to get this together for quite a while, and it's always very gratifying when it comes together and there's a crowd and a great lineup of companies, so I'm excited. So here it is. So I'm just going to get going. I know that Eric will probably talk about macro pictures a little bit more. So each presenter has their own thing that they're going to focus on. What I want to talk about is expectations and opportunities. So we're all here because we believe in mining. We believe mining will rise again on some timeline to some height, and that's fantastic. It will. We all know that. But just waiting for that to happen is boring, first of all, and it doesn't make any money, at least right now. So what I'm focused on these days is looking at how to be active in the interim. The bull is not going to start tomorrow. Wish that it would. We all wish very much that it would. But it's not going to start tomorrow. But there are things that you can do in the interim that can give you, that can add to your portfolio, that can give you profit. And while you're doing that, that keeps you engaged, it keeps you interested, and then there's also all the work to be done to set up your portfolio for when, so that it performs well as this market picks up again. So it's there's short-term goals, there's medium-term goals, and there's long-term goals. So that's what I want to go through today. Now, this could be obviously a day-long topic in and of itself. Not going to talk about it for very long. Obviously, the markets are in mayhem right now. I think the line that I used in my last newsletter was that a deaf hibernating bear couldn't have missed the fact that the markets were melting down. We have a lot of significant markets around the world that are now in official bear territory. That graph along the side is percent that markets have fallen below their 52-week high, and that's a lot, and it includes Canada, all of Europe, China, Japan, Russia, Brazil, Argentina, Sweden, the Philippines, a long list. Also significant, the correction that we had in August, that was not very long ago. Back-to-back corrections, so falls of more than 10%, haven't happened very often in the last 100 years. They've only happened in some pretty bad times, 1929, 2000, and 2008. So clearly we are in tenuous times in terms of the global markets. Looking ahead for markets, I don't have a lot of confidence. One reason for that is earnings. During the entire US bull market, one of the very reliable aspects of that bull market was that earnings each quarter compared to the previous year kept rising on 5% on average from the end of 2011 through to the beginning of 2015. That trend is now over. So now we're looking at, in the second quarter, earnings fell 0.7. In the third quarter, they fell 1.5%. Wall Street expects fourth quarter earnings, which are just starting to hit, to be down 5.7%. That's the kind of number that can tip a tenuous market, in a bad direction. So I don't think the markets have a lot of strength in them right now. There's a broad statement if you want to have one. Underneath that, the US economy is a different question. I would describe it as being just okay, which isn't bad, but it also isn't particularly stable or good. And something that's just okay can tip into the bad side of things quite easily. I'm not going to go through this, but this is the list of the kinds of factors that could tip the US economy into negative territory reasonably easily. Europe, oil, confidence, bond crisis, the dollar, what's going on with China's currency. So things are tenuous. That's not necessarily a bad thing for those of us in this room. In weak markets, what do investors want? They want safety and they want value. Those are the ways that we turn, or that the general investor turns in a weak market. Of course, gold is one of the classic safe haven plays. The US dollar, of course, is is competition for that today, which has its own influences, but nevertheless, gold has been doing fairly well. That's a 60-day gold chart. It's not a bad-looking chart. So optimism that if the markets continue to weaken broadly, gold will benefit from that. And then there's value. If the US bull market truly is over, investors are going to start rotating into a search for value. Mining will surface in that search because mining missed the whole bull market. We missed the party. For now, that chart on the bottom is the GDX. It shows that gold miners at least, are currently sort of baby getting thrown out with the bathwater situation. They're not benefiting particularly from the price of gold. But if gold can continue to strengthen in opposition to a weakening market, then the gold miners, the mining sector, if other metals go with it, will disengage and start to perform. Gold certainly isn't the only commodity that I'm optimistic about in this kind of scenario. I'll speak more about it later, but I'm very optimistic about uranium. There's reasons to believe in zinc. There's other commodities that have interesting arguments behind them as well. Lithium is one of them. So those are some reasons for optimism in the near term. But like I say, what I really do is try and break my portfolio down into the near term, the medium term, and the long term. So I'm going to go through each of these in turn. So short-term trades. The reason that we're in this business is to make money, right? Let's be honest. We can fall in love with projects, we can fall in love with management teams, but we do it because we want to make money. If we want to look right now at short-term trades that give us the opportunity for upside, I'd say that I like how that bullet point just put them all as number one. I guess they're all equal opportunity. There's perhaps three games that I think you can play: seasonality, news events, and arbitrage opportunities. So let's look at those. Seasonality in gold. Most of you, probably all of you, have seen this before. Gold is very reliable in its seasonal patterns. This is the 5-year, 10-year, or 15-year and 30-year gold price chart. When the charts line up that closely, we certainly have a pattern in action. So gold has a reliably strong season to start the year, and then another one in August and September. And we saw it play out exactly in 2015. We saw gold gain 10% in January. That's a significant move. And then we saw it up 6.5% in October. Granted, October is a little bit late for the season, but that was because of the Federal Reserve and their rates decision. When that happens, when gold moves, you can get great leverage off of miners. This is not rocket science. This is something that we've all heard before. But here's some good examples of just how well that can work even when we're in a terrible market. So when gold gained just 6.5% last fall, equities, the GDX rose almost 30%. The junior gold miners rose 21%. Those are significant moves in a bear market. And silver performed just as well. Actually, silver priced it a little bit better, and the miners provided a similar kind of leverage. So you can really use seasonality to pick up 20%, 30%, as long as you have a system for it. So if you want to profit off of timing, you have to follow all 4 steps. If you just follow 3, it won't work. So you have to figure out what the pattern is. You have to identify the stocks that offer leverage to that pattern, because gaining 6.5% isn't great, but gaining 30% certainly is. You have to buy based on the timing that the pattern suggests, and then you have to sell. This is where I say the 4th point is very important, because those seasonal patterns have to come back down in order to rise again on the next part of the pattern. So you have to make sure that you sell and you give yourself a parameter. It's either by a certain date or it's when a certain gain is gotten, whichever happens first, and make sure you get back out again. Sometimes it's not going to happen, sometimes it won't work, but at least you're giving yourself the opportunity to gain leverage off of these fairly reliable patterns. So I did this at last season. Excuse me. Between mid-November and Christmas of last year, bought a list of gold explorers, miners, and developers. Gold peaked very quickly last season. By January 22nd, it was at its peak. But that's okay. It was, even though the peak happened a little bit more rapidly than the pattern suggested, I had my parameters set. So by the time gold started falling, I had already executed partial sells on several stocks, which meant that my cost base was down. Kamenak is a good example of that. I recommended it at 70 cents. Within 2.5 weeks, I think, it was at 90 cents. So then we sold a third. That means our cost base is now 60 cents. I love the Kamenak story. I absolutely want to maintain exposure to it, but I'll take it at 60 cents instead of 70 cents, right? So this is the type of way that you can profit off of timing. This year I've done a similar thing, identifying several gold stocks that I thought were particularly beaten up by tax loss selling and for specific reasons offered good reason that they should perform well if gold gains, and so some of those are doing that right now. Then there's news. This is in the worst part of the bear market, as things were still sliding, news events were liquidity events, right? Even if a company announced something good, often that was just an opportunity for investors to get out. So thankfully, we are past that now. We're at the point where good news from good companies is getting rewarded. So if you can follow a company very closely and you can gain confidence that you know what they're going to do, you have confidence that it's going to work, and you know sort of the timing that you expect it to happen, you can definitely make some money off of that. Pretium Resources provided us a great example of that last year. Anybody who followed the story knew that they were awaiting their permits, and that once the permits were there, they were going to deal with debt financing. Sort of they were happening at the same time. If you had confidence from the management team and from knowledge of the story that that was going to happen, you could gain 36% in just 6 weeks following the news, or as much as 55% if you'd bought a little bit before. That isn't inside information or anything of that sort. It's simply being close to the story, close enough that you have confidence that things will happen, and making moves on those confidence. So those are great gains to pick up in a bad market, what is still a bad market. Another interesting one is arbitrage opportunities. So there's a lot of deals being done these days, right? There's companies that are merging. There's properties that are being bought and sold. There's takeovers happening. Whenever deals happen, some part of the market doesn't always believe it right off the bat, right? And uncertainty translates as a discount in the share price. So a good example of this right now is Sunridge Gold. Sunridge Gold has this very high-grade project in Eritrea in East Africa. They had a good plan to get it into production themselves. Instead, a takeover offer from the Chinese showed up that's going to put $100 million in their bank account. Sunridge is going to wrap up operations and distribute that cash to shareholders. That will translate to 35 cents per share distributed to shareholders within the next few months, provided the deal closes. The market, always wary of Chinese deals that fall through, is discounting the likelihood of that deal, which means that you can buy Sunridge for 27 cents right now. You can buy it for 27 cents right now, and if you have confidence that the deal will happen, and I have reason to believe that it will, in a few months you will get 35 cents cash for the 25 cents that you're paying today. That's the kind of opportunity that's available today. Again, it requires that you follow a story closely so that you can gain enough confidence to overcome the market's discount. But the discount is opportunity if you can do that. Oren Gold is another one that happened for me last year. They took over a company called North Country Gold to gain full ownership of the project that they were exploring. Basically, the market discounted the deal just because of uncertainty about how share prices would move. If you had enough confidence in how it was going to play out, we were basically able to buy Oren shares for $1 through buying North Country shares that as soon as the transaction closed were worth $1.25. Again, that's the kind of upside I'll take it in a bad market, right? Okay, so 20% gains, even 40% gains are great, but we invest in mining because we like more than that, I would guess. So let's talk a little bit about one of the other good opportunities that I see today, and that's uranium. And we have a couple uranium companies presenting here today. So I'm just going to preface their presentations with my take, my very condensed take, on uranium and why it provides opportunity today. So the chart on the top is the uranium price over the last decade. Obviously, we had a huge run-up in 2007. Then the price corrected in and of itself because it was such a huge run-up. Then the global crisis amplified that correction. And then the Fukushima disaster slammed everything down to the ground, and prices have struggled since. It takes time for situations like that to calm, but that has now happened. The chart on the bottom, I know there's a lot there, but what it says is that there are now more reactors, nuclear reactors in the world, either operating or in the pipeline, which means they're under construction, they're planned, or they're proposed. There's more than there were before Fukushima. So the idea that nuclear is not happening because of Fukushima is wrong. Nuclear is happening more than it was before that nuclear disaster. Because of that nuclear build-out, demand for uranium is very strong. China is certainly a key part of that story. If China's pipeline, planned, proposed, and under construction reactors all come to fruition, it alone will boost uranium demand by 51%, which is huge. But China only represents 36% of the pipeline. There's lots of other countries that are also having significant build-out. India, South Korea, Russia, the United Arab Emirates, United States, these are some of the other ones who are building multiple reactors. Just the ones being built last year increased demand 8%, this year 14%, and the supply-demand chart is below. The black line is demand, and the colored sections are supply. Now that shows you we're facing a shortage starting in about 2020. Well, that's a little ways from now, so why should we care about uranium today if the shortage isn't going to hit for another 4 years? The reason is because nuclear utilities do not gamble with running out of fuel. That causes meltdowns, and meltdowns are not good. So nuclear utilities generally, almost all of them, cover their uranium requirements 3 years out. And that's because they need certainty and because it takes an entire year to turn uranium into reactor fuel. So there's a big time requirement here. So certainty and time come together. 3 years from now is 2019, so that's right before the shortfall hits. The other interesting thing is that when operators look 3 years out right now, many of them are uncomfortably uncovered in terms of their requirements. And the reason for that is that in 2007, when the price did its crazy spike, a bunch of operators, a bunch of utilities signed deals because they were scared that they were going to be stuck paying extraordinarily high prices for their uranium, and that wasn't going to work. So they signed deals, 10-year deals that are expiring in 2017. So between the timeline of requirement and the fact that these deals are running out, new contracts are imminent. And as new contracts are negotiated, that will support the spot price, because the chart that's here is a great chart from David Sadowski of Raymond James. His group analyzed a whole bunch of uranium projects and basically, by modeling each project, came up with the price that would be required to incentivize construction, and that incentive coming from the project at least generating some threshold rate of return. The bottom dashed line is the current spot price. The upper line is the contract price right now. The point is, very few projects can get built at today's prices. So when producers are signing new contracts with utilities, they're going to demand better prices because they need to build projects and they need better prices to do that. So that's the essence of the uranium argument. Amidst all of that, it's incredible how uranium equities have underperformed a price that in itself has struggled so much. Even contrarians, I would say, are sort of tired of waiting for the uranium story to turn around, and that's why you see this decline. But it translates into what I see as some very good opportunities in the uranium sector. So those are the three uranium companies that are here today. We've got Uranium Energy, who's going to be presenting next, Energy Fuels, and NextGen. So those are it's producers and two producers and an explorer, and all very strong stories that can give you some leverage to this uranium opportunity. Okay, I probably am running out of time, so I might start talking quickly. If we're looking at the medium-term timeline now in your portfolio, so what you want to buy to get ready. So by medium term, I mean, again, we're not waiting for the mining rally to lift these share prices. What I see in the medium-term argument are companies that have a good chance of either getting into production or being bought out before the rally starts, or companies that have exposure to commodities that are going to move before the broad rally starts. So these are companies that will move ahead of the big rise. So there's not a lot of near development assets that have answered all the questions. By that I mean permitting, engineering, infrastructure, jurisdiction. They have good economics at current metal prices. They're sensible to build. They have good exploration upside. There's not a huge number of projects that fit those criteria. So those are good medium-term buys, because those are the type that that have a good chance of either advancing despite the market still struggling, or being bought out while the market still struggles. Companies where a mid-tier has taken a stake, that's just another sort of aspect in that pattern. For example, Eldorado buying 15% of Integra. Eldorado has a pattern of buying stakes in smaller companies and then fairly often down the road buying out the whole company. There's no guarantee that that's what's going to happen here, but the fact that they made a move is certainly interesting. Small to mid-tier producers who have controlled costs, growing production, and a currency advantage. I'm sure we're all very aware that the price of gold in Australian dollars or Canadian dollars is a heck of a lot better than it is in US dollars, so currency advantages are significant in the near term. And then I also like companies with exposure to zinc. Zinc is a little bit like uranium in that people are kind of tired of waiting for the zinc story to happen, but the longer we wait for it to happen, the sooner it's going to happen, because it's a very strong supply-demand argument there that we're running out of zinc. Then you get to what I call the long-term holds. Short-term trades to get 20, 30, even 40% profit, that's great. Positioning your portfolio for the medium-term upside is also very important. But the long-term matters, and you will thank yourself 5 years from now. Whenever mining really starts to run again, you will thank yourself for spending time today and money today buying companies that are incredibly undervalued that will really get that leverage when the market starts to move. So in that, I think you're looking for cream of the crop explorers. You're looking for well-managed project generators, as a similar sort of category, so exploration. And again, miners with controlled costs, manageable debt, and growing production. So those are ones that you pretty much buy and forget. Maybe you manage your cost base by selling a little bit if they spike and bringing your cost base down. But in general, you're buying them and forgetting them because you know with this and good management teams, you will thank yourself down the road for having held them. Now, what I'm talking about is both easy and hard. It's not rocket science. Nothing that I've said is particularly complex. But the hard part is keeping up with it all, right? So timing is predictable and not, like last fall's gold rally being delayed by the Fed exchange, this January's gold rally being just a little bit complicated by the fact that the global markets are falling apart. So you have to really pay attention in order to make these timing arguments work. If you want to play news events or arbitrage opportunities, that requires being very up to date on a company, being really close with, I don't mean close with, but being very close to the story. You have to keep up with it, so that's hard. And even in terms of determining which medium-term and long-term buys, there's still a lot of options out there. It takes time to figure out, which ones you should choose. Now, the fact that you're here today certainly suggests that you are taking advantage of some of the things that are out there to help you figure this out. And I would say newsletters, Eric, he's over there, has for a long time generated a very valuable product. Brent has also for a long time generated a very valuable product. I would say in the newsletter sector, you have to be aware that there's a spectrum of newsletters. Some will accept payment to be written up, and others will not. And one of the things that Eric was mentioning about this being a curated list of companies is that the three of us certainly, so to speak, you can't buy coverage. This is what we are buying and what we are selling and why. And so taking advantage of people who are going to spell out all of the work that they are doing, figuring out the sector, all of the experience that they have, figuring out what works, taking advantage of that knowledge is really important. So doing that and coming to events like this. So that's all I have. I'm really glad to see you all here. And thanks. I hope that was an okay introduction to the day.